Hello everyone, I'm Hardwick Walthall, an attorney in Maynard Nexen's corporate and tax practice groups. More often these days, a buyer acquiring a business will insist that the sellers accept some amount of rollover equity in the deal. Rollover equity is ownership that is either retained by the sellers in the target business or issued by a buyer company to the sellers as part of the consideration for the sale. A buyer in this situation will typically consider a transaction structure that allows the sellers to defer the tax on the rollover equity value while balancing the buyer's business and tax objectives. From the standpoint of both the buyer and the sellers, the structure of any transaction with rollover equity should be considered very carefully. Here are some key considerations that will impact a rollover transaction. A rollover transaction provides a buyer with several important benefits, such as allowing the buyer to reduce the amount of cash consideration paid in the deal. A buyer is also generally insistent on obtaining a step up in the tax basis of the target company's assets based on the cash consideration paid, which step up will provide the buyer with future tax write-offs for the business following the closing. On the seller side, a major concern is that any rollover equity is structured so that it is not taxed when the seller receives it. The ability to do a tax-deferred rollover will depend on several factors, including the business entity type of the target company and the buyer entity issuing rollover equity. In addition, the tax laws governing contributions of property to a corporation or a partnership in exchange for equity must be carefully considered to ensure the rollover equity is not taxed when issued. Several different deal structures are typically considered in a rollover equity transaction. One common structure involves dropping down the assets of the target business into a new LLC, with the buyer purchasing equity of the new LLC. This transaction is treated as an asset purchase for tax purposes, even though the buyer technically purchased equity. If the target company is an S corporation, another common structure involves an F reorganization and can achieve the same favorable tax results as the drop-down structure. The best approach when structuring an equity rollover will depend upon all the facts and circumstances of the specific deal. As is often the case, no one structure will accomplish all the parties' different tax and business objectives. Still, with effective legal counsel and proper tax planning, the parties can usually come to some compromise in designing a transaction structure that strikes the right balance and allows the deal to proceed.